Thank you, everyone. And I am delighted to introduce a Polen Perspectives discussion where we try and unpack topical events and convey our thinking to clients. I am joined by Damon Ficklin and Rob Falker. Damon is lead portfolio manager for our global growth strategy, and Rob lead portfolio manager for our global small and mid company growth strategy. Welcome, gentlemen, and I appreciate your time. And I do think it very relevant to ask your insights, given your long experience of managing client assets through both calm and turbulent times. So Damon, Rob, I know you are both keen to reach our clients and provide some comments in light of what we are seeing in the markets. And while I caution our investors to remain focused on the long term, as I know you do when investing our clients' capital, but maybe you can provide a few words as to what you are seeing in the market currently. And Damon, if I come to you first, and then we can hand over to Rob.
Sure, I'll kick us off and make a few comments, and I'm sure Rob will build on that. But look, we always kind of try to see the big picture, and that's not just in this moment, that's always. We have a 5-year investment horizon, so that's the way we approach investing. And so as I look at what's going on today, we saw starting in around the November time period last year and building up to today that, monetary policy is shifting, right? We're going from zero to very low interest rates around the world to now inflation forcing the hand of monetary authorities, and rates going to move up. That's a big deal in markets. And so that's creating a lot of consternation around the valuations. In addition to that, we've had a ton of fiscal stimulus in the US specifically and broadly around the world for the past couple of years, and that's really tailing off. So two big forces, or positive tailwinds, if you will, for the market are changing directions. And so the market is adapting. That doesn't spell gloom and doom. I think it's just a natural part of cycles, but we've been in a very positive part of the cycle for a long time. So valuations are adjusting. If we look at, just using global growth as an example, I look at the last 25 months. So we were up roughly 24% or so in 2020, and then about 18% in 2021. Now, year to date, close to a -10 as the markets are adjusting. Put that all together, that's roughly a mid-teens compound rate of return. That's actually quite sensible and what we would expect over a longer period of time, and very in line with our underlying fundamentals. So I know it's disconcerting, or it's not fun to go through this volatility, but the whole picture, when you kind of step back and widen the lens, makes some sense. We think as we go through this year, there's going to be some interesting outcomes as we come out of the pandemic, or the recovery from the pandemic, and we get back to just operating in a quote unquote normal environment. But we think our companies are positioned to do just that, right? We own secular growers. And so we remain confident as we look forward, we're in a really good position to drive good returns for our investors. So I'll stop there and turn it over to Rob.
Yeah, just to build off that, I would just say that, we track the performance of the companies we own, and early indications in early fourth quarter results is that they're performing unbelievably well. And so we're encouraged, right? When we think about the businesses, the high quality businesses we own, we want to think about if they're on track for the next 5 years plus, and all indications are that they are. And so those businesses are compounding at highly attractive rates, and they're getting stronger. I mean, that's really what we glean from a post-pandemic or soon to be post-pandemic world, is that our businesses got stronger through very difficult times. And this is an opportunity for them to even spread further. So we're encouraged. Obviously the volatility isn't settling, but it also creates a number of opportunities, which we'll get into later.
Okay, well, thank you both for that. And maybe, Rob, if I come to you first this time, but so some managers would look to take advantage of this market volatility. Is this something you believe in, and have you taken action in the portfolio in any way?
Yeah, absolutely. So as we've discussed with our valued clients, turnover is typically very low in Polen strategies. In Global SMID, it's been a bit higher recently, because with volatility comes opportunity. And we talk about how the intrinsic value growth of the companies we own is far less volatile than the stock prices that we see day to day from Mr. Market. And so as these companies, these high quality companies, have suffered severe drawdowns, we are adding to those businesses, and we are trimming companies, as you think about our safety growth spectrum, that are further on the safety side, And this is what we do best, right? The market gives you these opportunities and you take them. And so we've been a bit more active in the marketplace and adding to companies that we have firm belief that the fundamentals are sound, that the valuation is incredibly attractive, and that we can deliver compelling returns to our clients over the long term.
And I would just build on that. I mean, a very similar theme as you look at going back a little further in 2021 as a whole. I would say if you look at most of the activity within the global growth portfolio, it was being mindful or managing valuations in the environment, kind of building up to this moment and recognizing that markets have gone up a lot more than fundamentals, right? And so eventually that resets. We never know what exactly is going to reset that. I think we're seeing changes in monetary policy, and the lapping of COVID is one of those triggers, and it's happening right now. But been very mindful around valuation, as Rob pointed out. While not fun to go through these drawdowns in these periods, it does create opportunities. And so we trimmed at the beginning of 2022, we trimmed Microsoft, we trimmed Accenture. They were two of the strongest performers in our portfolio in conviction positions during 2021. They were a little more dearly valued, and we saw companies like Adobe pull back 20+%, Align pull back 20+%, and all of a sudden valuations are quite attractive for those businesses. So we took some of those proceeds and added to those positions. And we're being patient because it's a quite volatile environment, but I think we're going to have more and more opportunities, and we're going to lean into better valuations and strong secular growers and deal with any challenges that come. But I think we're very well positioned. And if you look at the global growth portfolio's aggregate valuation today, it's roughly 28 times forward earnings. That is not very different than what we would have seen any time historically, even pre-pandemic. So while the market has been a little elevated for a while, our companies are, we think, quite fairly valued for the growth that we believe they're going to deliver over the next 5 years.
And maybe, Rob, just swinging it back to you a little bit in terms of that sort of valuation and growth prospects. How have you found that in the sort of small and mid company spaces?
Yeah, similar to Damon, we were opportunistic. So just as an example, we trimmed Toronto Stock Exchange, which had grown quite sizable in the portfolio. It had grown to nearly 4.5% of the portfolio, and we trimmed it to 3%. And the reason we did that is, of course, the Toronto Stock Exchange benefits greatly from volatility, right? As other managers trade quite rapidly. So we used those proceeds to redeploy that capital into Floor & Decor, which is an American retailer. Think Home Depot, selling tiles to families that are doing renovations. And we also reinvest in Revolve Group, which had a quite severe drawdown, but the fundamentals are actually accelerating, not decelerating. So it's those type of opportunities that I wanted to get a bit more specific on. But this is the beauty of volatility. The markets can be irrational in short periods of time, and we want to take advantage of that. The correlation on the drawdown geographically and by sector was near 1 for companies, and there was very little spread between good and bad and neutral. And so we wanted to use that opportunistically to upgrade the portfolio during this turbulent time.
Okay, thank you for that. And look, I appreciate the investment philosophy that we have in place has been tried and tested for more than 3 decades. And is there any kind of similar experiences that you can point to in your past? And also, are you intending to make material changes to that process to take into account what we're currently seeing? And maybe Damon, I'll come to you first.
Sure. Yeah. I mean, look, we've been executing this investment discipline for more than 30 years. So we've been through other what I'll call challenging environments, whether that's the global financial crisis, the technology bubble bursting, in other shorter periods of pressure or challenge within the market. We haven't, and we don't need to change our approach, because it's very much about owning the highest quality secular growth companies at fair prices, letting them drive the outcome over time. So that doesn't change given the environment. We will weather through this. We've weathered through well in other environments. One thing that I would highlight, like every period, every challenge is a little bit different, right? They unfold differently. What we see happening right now is when the market has a strong rotation, if fear kind of creeps into the market or long-term outlooks change dramatically, there's just a kind of across the board sell-off, right? There's not a lot of discernment when you're talking about a 2-week, 3-week rotation in the market. But eventually, investors kind of start sifting through and understanding where they want to maintain equity, where they want to maintain risk, what's worth holding, what they don't want exposure to. So that comes back out in the equation. It gets balanced out. So while we're dropping in terms of returns near term, the same as the market, I think when you kind of listen to some of the examples that Rob and I are pulling out, and we could do that across every company in our portfolio, the strength of the business is there. We're confident they're going to drive a long-term outcome. And eventually that's deciphered. And I think that's what creates separation. So try to pull out of the moment of the month or the quarter or the immediacy of the environment and just step back and realize what we're trying to do. And fundamentally, that doesn't change. It can't change. There's nothing esoteric, black box about it. It's a fundamental, down the middle, own the best companies, and they will drive the outcome over time approach.
Okay, and Rob, to yourself.
Yeah, sadly, these times are not as rare as we'd like, right? Earlier in 2020, of course, for the pandemic, the fourth quarter of 2018, the summer of 2011, 2008, 2009, the list goes on. And I'm sure I've missed 5 others in between those periods. But, this is the beauty of our investment process and philosophy, is that, as Damon said, this is tried and true over the long term. And the reason we're so calm is because we know it works, right? Owning the best companies over the long term delivers superior returns to clients. And the beauty of acting and thinking like an owner is that you think 5 years out. And at the end of the day, earnings growth is what matters most. And we can resend many of you a heat map white paper that we did that will highlight this and I think bring it to life. But when stock, here's a different way to say it. Multiples go down for 2 reasons. One is the stock price goes down, and 2 is the earnings growth goes up a lot. And both are happening right now. And we believe that earnings growth will win out and provide the great returns that you all expect.
Appreciate that. So just in terms of the sort of final closing, is there anything else that you'd like to convey to our clients? And again, I'll come to Damon first.
Yeah, I just say, rest in the confidence that we're executing the same process that we've been executing for 30 years. Hopefully that confidence is coming through in how we're talking to you and expressing it. We don't care for these markets any more than anyone else. It's more fun when it's kind of going steadily up and to the right. But this is the reality of business cycles, market cycles. It's all part of the process of compounding wealth over the long term. So we know exactly what we need to do. We have great companies within our portfolios. We're ready to take advantage of opportunities that the market presents, and we're going to keep on keeping on. So we really appreciate the investments that you made in us and your confidence.
Yeah, just to echo, just know that I own the fund along with you, and I hate seeing what's been happening in the markets as well. But what I do know is that durable, high quality companies are advantaged, and so I'm excited about the companies we own and what they can do in the long term. So we'll continue to study the market and think about opportunities that we can take advantage of here now, in the future. But we appreciate your confidence in us, and thank you for the time.
Appreciate it. And again, once again, thank you for your time. We're always happy to answer our clients' concerns or questions. So please do contact your local representative should there be any follow-ups. And on behalf of the entire Polen team, we thank you for listening.